Good morning, everyone. Welcome to this monthly market meeting. I did really feel this was an important meeting considering the sharp sell-off we've had in global equity markets over the last 3 or 4 days. A lot of volatility. It began on Friday after some concern over the US employment figures. The unemployment rate increased to 4.3%, which was a concern. And then on Monday, the Nikkei dropped by 13%, its biggest daily decline since 1987. And of course, that set the cat amongst the pigeons, markets very jittery. Hopefully none of you were too stressed by it. So there were various reasons for the volatility, from the US employment figures to the yen carry trade being reversed by a very sharp rally in the yen. So stability seems to be returning. And the main thing is the fundamentals are intact. There really is a very low risk of recession. We'll cover the various points during the course of the presentation this morning. So low risk of recession, inflation is coming down, bond yields are coming down, interest rates are declining, and of course, with the recent sell-off, valuations are now much easier. So it's quite normal for heavy corrections to occur during bull markets. It's actually quite healthy. So we've got a bit of an analysis picking from really incredible macro research that we're fortunate to get. There's a report from Alpine Macro with a title, "Why Are We Still Bullish?" And then a very positive outlook still from Capital Economics. Their outlook remains positive. MRB, they are positive about economic growth and risk assets. And then we're going to move on to cross-border capital. Yeah, let's begin then with the report from Alpine Macro. The fact that the Fed is only a month away from easing at a time when the economy remains resilient, actually quarter-on-quarter annualized GDP growth in the second quarter of 2.8%. All this suggests that the economy has so far skirted a recession, which is all important for earnings growth. We have mentioned already the unemployment rate increased last week, the July data, the unemployment rate increasing in the US to 4.3%. The rapid adjustment in the labor market, however, is primarily reflective of a return of labor supply rather than a rapid fall in labor demand. And here is the data. Since the beginning of the year, unemployment has increased by 895,000, out of which 419,000 is from an increase in re-entering job seekers. The rising labor force participation rate for prime-age workers, together with a large number of undocumented workers, i.e. immigrants, have both contributed either directly or indirectly to the increase in the unemployment rate. And we're going to have a bit more on that from MRB. So actually, the fact that the labor participation rate is rising should dampen wage growth. And wage growth has been one of the main culprits behind inflationary pressures. They go on to say economic recessions in the US are always preceded by financial crises. The good news is that financial stress has been easing steadily since early this year. And they've got a graph of the Kansas Fed Financial Stress Index. And that really does show a very constructive trend. Nevertheless, the message for policymakers is clear. They need to drop rates sooner than later, and they will do. We read the sharp sell-off in stocks and the big rally in bonds, as a warning shot for the Fed that policymakers don't have much time or space left before acting too late. And then they look at previous episodes when we've had sharp pullbacks in a bull market. And as you know from recent webinars, the situation is very similar to the one of the late 1990s. The only time the Fed eased in an expanding economy was in 1998. This set the stage for the parabolic move in stock prices, with dot-coms leading the way. Today, we are dealing with the same macro policy and market conditions. The internet bubble in the 1990s was supported by soaring IT investment and enormous gains in labor productivity. Today, we're experiencing an identical boom in AI and a sharp increase in labor productivity. And labor productivity growth has been soaring in recent quarters. Last report, unemployment in the US from MRB, don't fret about rising unemployment. The rise in unemployment over the past year does not constitute a bearish economic signal. A large exogenous increase in immigration plausibly explains much of the recent increase in unemployment. Without it, the unemployment rate today would be as much as 40 basis points lower. There has been a historically large increase in immigration. Unemployment is not currently rising because of people losing their jobs. This is a departure from the nature of prior increases in unemployment that led up to recessions. The Bureau of Labor Statistics Household Survey of the Labor Market indicates that the foreign-born labor force has increased by almost as much as the native-born labor force since 2022. Between January 2022 and June 2024, the native-born labor force has risen by 3.8 million. 2.4 million due to higher labor force participation and 1.4 million due to population growth. The foreign-born labor force has risen by 3.5 million, about 0.9 million due to high participation and about 2.6 million due to a higher foreign population. The jump in immigration since 2022 has had a huge impact on US labor supply. So instead of being 4.3%, the unemployment rate on a normalized basis would be closer to 3.9%, according to this research. So with that, I will hand over to the local report. And yes, I think that will probably be Sean this morning. Sean, over to you.
Hi, Nick. As usual, thank you very much for the update. So let's hope that the global markets continue to move in our favor for the rest of the year. So now that we've covered the global universe, let's just move on to the local side. So first up, we'll run through the latest PMI figures as well as the business confidence index. After that, we'll move on to PPI, trade balance, and new vehicle sales. So when we look at the PMI figure, PMI for July came out at 52.4, which we saw an increase by 6.7 points compared to the June figure of 45.7. This was a positive surprise, indicating that Q3 has kicked off by putting its best foot forward. The rise in the statistic was driven by both an increase in domestic as well as external demand. But the most important point to note is that respondents' views of prospects in South Africa for the next 6 months have improved. A score of 50 is indicative of expansion. Hopefully this continues in August. However, I think it's important to note that this follows 2 months of weak PMI readings in both May and June. So with only 1 month above the 50 mark, it's too soon to tell if this trend will continue. Usually, for a leading indicator like a PMI, we'd want to see at least 3 months of above the 50 mark before deducing anything about being in expansionary territory. Moving on to the business confidence index, we also saw that's increased. It's currently at 69.4 from 68.1 in June. That can be attributed to a number of reasons. So the first up being renewed confidence from the formation of the GNU, stabilized electricity supply throughout the country and a lack of load shedding. Input costs continue to soften in July as well, with lower fuel prices as well as a stronger rand. And was expected to continue in August, with a 0.4% decrease in fuel prices expected. Second up on our list, we've got PPI trade balance and new vehicle sales. The annual PPI figure for June was 4.6%. On a month-on-month basis, it decreased 0.3%. The PPI for last year on average was much higher, sitting at an average of 6.7, compared to the forecasted average for this year at only 4%. For the current trade balance, we saw a current account surplus with 24.23 billion stat coming in at June, following a surplus in May of just over 20 billion rand. It is a highlight since it's the largest trade surplus South Africa has seen since May 2022. If we look at the trade balance formula, it's exports minus imports. So that stat or the figure is made up of exports declining by 3.4%, whereas imports have declined by even further 6.5%. For new vehicle sales stats have been released by NAMSA, showing that they are just slightly up 1.5% on a year-on-year basis in July. But this does come from a sharp decline in new vehicle sales of 14% in June. If we also just look at credit, so far this year we've seen weak household credit growth, but on the corporate side it looks a bit more positive because they're showing more positive signs with resilient growth over the same period. And then just finally, if we touch on the local portfolios, as you've all seen, it has been a bit of a bumpy road with the sell-off in global markets. South Africa is no exception. We've seen a sell-off pretty much across the board. The rate cut in South Africa is still expected to start at the end of September this year, with a total rate cut of 100 bips expected by the end of 2025. Overall, we expect the current drop to be short-term in nature. The current environment in South Africa looks positive, as mentioned by the previous statistics. Therefore, we don't see this as a cause for concern. And our current view is that we're keeping the local portfolios as is for the time being. If anything, the sell-off presents some potential attractive entry points. And that being said, we are keeping our finger on the pulse. We haven't made any decisions just yet, but we'll be sure to keep you all updated on any changes from our side.